In the last video, I talked about the pros and cons of trading stocks, and if you haven't watched it yet, how dare you? Go watch it now, or or not, whatever. You probably came here specifically just for futures, but it's there if you guys want to watch it. So first things first, unfortunately, it's the world we live in, but I'm not a financial advisor. I'm not a broker dealer. I'm not anything to do with you financially. I have no idea who you are. I don't know what your financial situation is or anything like that. Please consult a registered financial professional. Any actions that you do or take, the consequences and everything befall upon you solely, as you are a functioning adult and you make your own decisions. I, in no part, condone or advocate anything. Everything here is just expressly opinion. All right, so to kind of pick up where I left off on the other video, yes, I am wearing the same shirt. I am shooting this all in the same day, and I'm trying to get this out as much as possible. I've been kind of backlogging this for a while, and the problem with series is that I can't take a break until it actually pushes out completely. And this is me just trying to push through and grind this out so I can actually talk about the stuff I am interested in at the time. So without much further ado, let's start with the pros and futures markets. The first one I would say is that there's a 24/6 market from Sunday 5 p.m. to Friday 5:45 p.m. The second pro is that contracts only need a fraction of the contract amount with a broker. And to put it in layman's terms, you're essentially getting a higher leverage than what you would normally get if you were essentially trading stocks or I wouldn't say options, but like I would say just trading stocks. And it's in the pro category mostly because, and I hate to say this, but like most people can start out with $500. Not saying you want to just start out with $500 with futures trading, but I would say to really think about it before and consult someone who actually does trade futures well. Don't just trade. Don't go consulting just anybody just because they say they trade futures. Make sure they actually trade futures well. And the reason why I say that is because um, we're not even in the con section. I'm already in this, but there's a lot of clowns out there that say they trade futures. There are people out there that will tell you what you want to hear just because, for whatever reason, try to sell you something, whatever. There's always an underlying reason out there, right? And the best thing for you to do to get accurate information is just, I would say, go to the source. Like, go see what the CME has to say, go directly to your broker, see what they have to say, their fees, any sort of special rules, special scenarios like the circuit breakers and stuff like that. Like, these are things that you should research on your own. And it's nice that if you have a friend that trades futures and everything, like I have a ton of friends that trade futures and forex and all that sort of stuff, but I don't take their word at face value. It's not that I don't trust them. It's just that we sometimes are, and I'm subjected to this as well. We're sometimes subjected to outdated information, or we go into scenarios that we never thought would happen, or it's just uncharted territory for us. So, like, obviously, you guys have to do your own research because this is your money, and it's important that you understand if you are going to essentially gamble with your money. You should at least understand, like, how and why at the very least, right? All right, now the third pro is that you know how we have or if you guys have never traded futures before, when you trade, let's say the S&P 500 or whatever it's called, the E-minis, or ES as it's referred to as, when you're trading one of those contracts, um, obviously every tick is about like 12 and I believe 12 and some change or something like that, but I think it was 12 and a half. But so about 12 and a half. Now they recently introduced a new contract called the micros, and these contracts I believe are about $1 a tick. And again, obviously you have to do your research. I could be wrong about that, but they're about $1 per tick, and so they're about like a twelfth of whatever the ES contracts are. And what this did was that it actually lowered the barrier of entry for you doing futures trading. Obviously, I have my reservations about that because anything that where you lower the barrier of entry, and I'm not trying to gatekeep here, but it kind of does this thing where it's like people don't take trading seriously, and it's like now it's even easier for them to trade it. Mentally they don't take it seriously, and that's basically something I always take issue with. Is that, like, if you have a higher barrier of entry, you're gonna have to have some effort so that and they know that once they obviously get in, that they don't want to lose that, so obviously they'll take it seriously. Whereas you lower the barrier of entry, it's like whatever, it's going to become a revolving door situation, right? All right. The fourth pro is that all the shadowy manipulation you see that I talk about 90% of the time with the dark pools and like institutions possibly moving at a certain price or whatever and trying to essentially guess to see why they see something or what they're thinking. Um, all of that is not very, at least in my opinion, not very evident in the futures trading market because there's like all the books are basically like lit. There's no dark pool. There's none of that stuff. There's basically just if you were to move or if an institution was to move like a million contracts at a certain price, you could see that on the book. You won't know, and they probably won't do it all at once. But if you see like some people who are volume-based traders will probably see this more prevalently, where certain price levels see a huge spike in volume, or they're more actively traded in that spot. It could be an institution adding on, it could be offloading, but you know that that transaction around that area, there was a transaction that was occurred. And I think that is actually very transparent compared to what we get nowadays, especially in the stock market or even Forex. Like Forex does not give you a consolidated tape. All right, the fifth pro in my mind, and this is kind of an expansion on the other pros, but it's that the futures market isn't fully electronically manipulated. And what I mean by that is that essentially there for the other markets, right? And I know everybody's adapted to the whole like efficient market theory versus the adaptive market theory, which if you guys have never seen Andrew Lowe, I'd suggest you check out some of his videos. He's an MIT professor, great dude, great. I love the theory and whatnot, but this was told to me back in the day, back when we had futures traders back in my firm. The thing with the futures market, it was essentially seen as the last bastion because, especially for electronic trading, because sometimes, like for other markets, obviously, right, there is a rhyme and there's a reason and stuff like that, and they try to enact the whole efficient market theory. So everything is appropriately priced of where it is, unless something happens, obviously, right? Whereas the futures market, it can go up, it can go down for whatever reason, right? Like it's just like you ask people why are the futures moving up? It's like no, it's moving up, whatever, right? But if you also think of the implications of it too, right? Why did they not want this to be like why did they hold out for so long, trying to electronically manipulate or hold out on this thing, right? It's that um, it's that whole notion, and it was a crackpot theory, but it made sense in retrospect, where if you control the futures market, you can control all the other markets because everything else is chasing the futures market. So if the futures is leading the downward move, the rest of the spot market is going to chase after it, obviously, right? Like that's like the whole market, especially the SPY, is there to track the big S&P and everything. And if you can control that with the futures, like that, you don't need to control the spot market. It's just the spot market will always try to snap back to where the futures are. And before you quants jump on me, I know there's correlation, there's co-integration, but we're talking about the S&P 500, and we're talking about the SPY, and like the SPY is there not to outperform the futures. The SPY is there to track the S&P. Like if it's going down, there you can be sure that they're going to try to reweight it so that it tracks the futures accurately. And therefore, if it means selling some shares, it might do that. Again, I don't know fully how a fund works, but I understand there's a correlation and co-integration argument there, but not in this case. All right, now on to the cons. And sorry if it seems like I'm trying to brush through this. It's just I feel like I've been stuck in this like series for a while. I'm just trying to breeze through this so I can actually move on to more like essentially up to date stuff. But the first of the cons would be obviously, like I mentioned before, the futures leverage, and it could actually, if you guys have not seen it, there is an article. I'll probably link it somewhere here. But there was an article about how there was a futures trader who was doing oil, and there was a possibility that oil prices could actually go negative. It's never ever been seen before, But essentially, what happened was that because the brokerages did not account for that situation, they didn't program it into the platform. The dude got stuck. We went negative oil, and the dude got screwed beyond what his margin was. Thankfully, Interactive Brokers stepped in and said that, you know what, that's our bad. We will cover your $9 million in loss or whatever the hell it came out to be. But know that that can happen. Like, because of the leverage, you can actually exceed whatever your deposit amount is. All right. Con number two. Um, in the other video, I talked about, like, pre-market trading and all that sort of stuff. Like, you guys have access to this because there's not really any restricted access unless you're on like one of those trading combines or anything like that. But um, futures can have huge gaps on their Sunday open, and some of the more prevalent stuff I can remember was that back when we were having the Euro crisis, back when essentially Greece was on the verge of default. I mean, at this point, I don't even know if Greece is actually defaulted or not. It's just always gotten so close to the wire. But huge gaps can occur, and sometimes they can be in your favor, but sometimes and more often times, since 90% of traders lose, it's going to be against your favor. And every full handle, which is like, every tick is about a quarter, and then four of those ticks become a full handle or whatever, right? Imagine being down like essentially 20 handles on whatever over leveraged contract you're on, and you're basically destroying your account and then some. Con number three is more of like a personal kind of thing that I dislike, and it's having to do with the contract price variations. And like if I was to look at livestock, for example, right, livestock would be, every penny rather than every quarter. Every penny is about $10 per tick, and compare that to the ES, which is like, it moves in quarters, but every quarter is about a $12.50 move per tick. There's no way to essentially break that up. Um, it's always like a set defined price move per tick, and that's, I don't know. I feel like there's not much control to that. Like I personally don't like it. But again, number three might just be a personal preference situation. So it's up to you whether you want to, really like and trade futures or whatever. Take this as, con number three. And then finally, con number four. I did say I don't like leverage products because it sort of creates a low barrier of entry, and like I said, I like the middle ground of that. It's hard to kind of quantify, but essentially, I don't think it's very fair that if I wanted to trade the E minis or whatever, right, all I need is $500, and I can slap on a contract and just mess around with that, right? But if I was to trade something like, I don't know, sugar futures, for example, right? I think there was like a 25 or $30,000 requirement just for one single contract of sugar futures, and that to me is kind of like, it, in between that is kind of like where I like this. I think would be fair. Like, can't make it too cheap because anybody can throw away $500 consistently and whatever. It just becomes a revolving door. It's a bad situation. You don't want to make it too easy for those people because they're going to do stupid things, and they're not going to treasure that loss. They're going to be like, oh, I got to refill this account right away. It's only $500, that sort of stuff, right? Whereas something like 30 grand, I believe that's actually the medium income, or around the medium income in the US, but 30 grand, that's ridiculous. So you're telling me that I need to save up for an entire year, or actually probably even more than that, because obviously you have expenses and stuff, right? You're telling me that I have to save up for multiple years just so I can trade one sugar futures contract. That to me seems very unfair. That to me is setting the bar way too high. There's no like balance to that situation, if you know what I mean. So for the middle ground stuff, obviously I did talk about it in like con 3 or whatever, but uh, there is one way that you can kind of mitigate it. It's having to do with a little bit of creative thinking, and that's utilizing the either options market or something in stock. Now, the disadvantage to it is that the options market is almost without question between 9:30 to, if you have extended hours, depending if it's a DTF or one of those approved options as well, like the SPY and stuff, up to 4 o'clock or 4:15 for some of those extended certain chosen options. You can obviously go to stock as well, because then you could start at 4 a.m. to 8 p.m. and you have that, buffer window of like, having it managing your place. And since the futures market is actually open a lot longer, I think they shut down like for 15 minutes after 5 o'clock or something like that. But essentially, you can hedge yourself very actively even while the market's closed using the futures market. Um, it's not a good thing, but it's also not a bad thing as well. If you know what you're doing, obviously everybody keeps saying that if you know what you're doing, and the only way to actually use it successively is to do a lot of research and just make sure you know what you're doing beforehand. Plan out every single possibility, every single move, and obviously, if something goes bad, good or bad, and that sort of thing. And the last middle ground is something I'd like to throw in the cons, but it's kind of hard because, again, not all of them are built the same, but a lot of them follow the same principles. But it's having to do with all the trading combines, or like the promise of funding. And prop firms have significantly altered from back in my day. And nowadays, it's basically you just pay someone, and they say it's paying for data or whatever. But honestly, you're paying professional. I believe you're paying professional fees for that data. But I don't give it enough of a shit to actually go look this up. But essentially, the way I see it is that they're pocketing that money. The ways that these combines are set up are literally set up for you to fail. And there's like a long drawn like sort of thing I wanted to rail them about, but you won't know this, or you probably won't believe me until you actually start trading some of them. And a lot of the people that I see take these things get really jaded from trading. And the sad part is that they don't realize that these places are literally designed for you to fail. And if not, like, they're trying to force you to trade because they want you to keep up with consistency or frequency or whatever the crap that is, right? But it's just, it's literally like you're spinning the wheel every single time. Eventually, you will lose on that wheel, right? And depending on how far ahead you already are, you can manage it. But oftentimes, most people can't manage it, and it just kind of spirals out of control because you're not thinking about how to trade properly next. You're thinking about how to not get shut down or get kicked out for something that you spent like 2+ months, because the bare minimum is at least 2 months, and then you enter on the third month with real cash to finally potentially get paid. Um, it's just it's all around not good. But it's something I can only tell you about. I can't exactly show you or give you the experience of it, but everybody there, I would say, seems like, just look at any of the testimonials for a lot of these combines. Uh, they seem like they're brainwashed. That's, I don't know if it's just me or whatever, but it seems like they're all brainwashed into thinking that they have hope that they can do this or whatever, and they can pass this combine and become a funded trader and all that sort of stuff. It seems kind of sad in my mind, but maybe sad's not the right word for it, and maybe it pisses you off. I'm not really sorry about that, because to be honest, like, trading's a hard job, and futures is a very hard job. Why are you making it even more difficult on yourself, playing by these rules that are literally designed to force you to wash out at some point, hopefully before you even break the 2 month mark, or before you even break the 3 month mark? Yeah, no, that's basically some of my thoughts on it. I have a very long drawn opinion about it, but that's not the purpose of this video. You guys can make your own decisions and make your own choices. You guys are all hopefully adults, but you guys have to make your own decisions and kind of live with it. But yeah, that's it for me. I'll probably start talking about the stuff that I have been kind of putting off for a long while. Most of the stuff that the longer plays, some of the seasonal stuff that I talk about. But yeah, until then, just remember, just because you're a day trader doesn't mean you have to trade every single day.